markets a little yesterday were a little bit on edge, to say the least. Are there lots more credit cockroaches out there, in your view?
In my view. So I'm not sure that there are necessarily a lot more credit cockroaches out there to the level that we've seen over the past few weeks. But I will say, as someone who's focused on credit for quite some time, you can usually follow the capital to challenges. And we've seen a tremendous growth in some private asset classes, private credit being one, and it's not particularly transparent. And that makes it really difficult to assess the true credit quality, true credit health of a big part now of the credit market, when there's been so much capital and perhaps not as much time to do really robust due diligence and underwriting.
And Winnie, what industries, though, could be most exposed to that? Because when I look at Tricolor and First Brand showing up in the auto space, but are there broader concerns?
Yeah, this is a good question, and one we've been mulling over with our autos analysts, trying to assess, is this something that is specific to just those handful of companies in terms of having true fraud issues, true structural issues from a business operation perspective? Or do we need to give bigger thought to just the amount of debt capital that's outstanding, not just for auto OEMs or suppliers, but within the personal consumer finance space with an ABS? And I think that it's always important to start to poke around. Now, when we look at, where capital has flowed over the past 5 years or so, there have been a number of sectors that have grown quite tremendously. When we think back to the kind of media and telecom bust-ups that we've seen for the past couple of years, that has to do a lot with the fact that just a lot of capital went into those sectors kind of leading into COVID and during the COVID pandemic. And so as we're looking forward, we always are looking at technology, at software, data centers, all of these things that have just seen such a robust amount of cash put to work.
It's interesting that you say data centers, because that seems like an area that could not be hotter, whether it's in the private or public markets. So if there are concerns in data centers, how long does that take to show up, though, just given that a lot of these are either starting to break ground or not even there yet?
Yeah, it's a really good question, especially because of just the way that a lot of the data centers have been financed, right? We know we have these massive hyperscalers with a lot of cash flow that, if one data center is eventually, not particularly successful, that's probably not going to be make it or break it. And there has been a lot of diversification in terms of how data centers have been financed within the ABS market, within the world of private credit for investment grade. So I do think it's going to take some time to really assess, what is the return on investment for all of the data center investment, for all of the AI investment. I don't think that we're necessarily going to have a full picture within the next 3, 6, 12 months, but it might be, here and there, we start to see some things that are a bit more challenging on the headline perspective.
I do wonder, though, it's interesting. I was looking at Zion's and it got an upgrade today. But if I go back to the October 13th, Moody's came out and said the outlook remains stable. I'm just putting it out there. And then you have what we got yesterday, and we're learning more about it. And then you did have an analyst come out over at Baird and said, actually upgraded it to outperform from neutral. Analysts noting the sell-off seems excessive. So I just wonder, David George is the analyst. I just wonder, it's hard to keep track of all this stuff, and I do wonder, there has been so much sloshing around for a while. Is there a good chance that we miss it or we don't realize that there's a problem until we're too far in? I don't want to be exclamatory, but I just, great financial crisis is hard to forget.
It really is. It's really hard to forget. And especially when you look specifically at credit markets and where valuations stand today, right? Investment grade trading at very tight spreads now, well below 5% yield. High yield, similarly, very tight spreads, below 7% on a yield basis. And when you think about what compensation am I getting for credit risk, it's much lower than it once was. So even if we don't have, a widespread systemic blowup like we had with COVID, like we had with the GFC, the upside downside feels a bit more skewed at this point to the downside within credit markets. That's not to say you have to sell everything. There's nothing to buy. There's definitely a good number of very high quality issuers where you can clip a coupon and feel reasonably okay about things. But the reality of credit markets is when you are lending, not every deal is going to be a home run. Not every deal is even going to be a single. Sometimes there are going to be losses, and whether, we have broad-based systemic fraud, I don't think that that's necessarily the case. I'm not necessarily worried about that. But when I think it just what credit valuations are paying me to tolerate right now, it feels like the skew is towards the downside.
Hey, one thing I'm curious, Winnie, though, private markets, they were there during the great financial crisis, but not like they are today. How does that potentially complicate things and the opacity of it, like that we just don't know what's going on?
Yes, it's true. It's hard to assess truly, what is going on in private markets in aggregate. Now, the good thing about private markets so far is that there is still a lot of liquidity on the sidelines within private markets. Just all of the cash that's been deployed into private credit, private markets, has not actually been fully invested. Also, we know that within private markets, it's a very fragmented lender and borrower relationship. There's just a lot of different types of companies that have been lent money to, and then also lenders. And so to think about, is this systemic, you would need to see some sort of event that was kind of widespread enough across the private markets to really pull all of that liquidity out. And given some of the structural considerations, that makes it a little bit more difficult to say, oh my gosh, private markets, this is the next systemic thing to be really worried about. But are private markets necessarily going to be just an ample source of liquidity without any problems, which has kind of been the case for the past few years? I don't know that that's going to be what we expect going forward.